Welcome to the Brtan Foltice Behavioral Finance Podcast, where we unravel the mysteries of behavioral finance and unlock the secrets to making smarter, more informed decisions with your money. Now, here's your host, Dr. Brtan Foltice.
Welcome, everybody, to the Brtan Foltice Behavioral Finance Podcast. It is me, Brtan Foltice, and today we're going to be talking about meme stocks and crazy investor behavior. And along the way, I want to introduce you to some of the terms that we use in behavioral finance and some of the ideas that we have around investor behavior. Both of these terms paint investors in a generally bad light, but we do have, I believe, some little bit of positive evidence coming out of this second round of meme mania. Thank you for listening today on whatever podcast platform you are listening to. If you like what you are hearing, please make sure you drop a like and subscribe and comment. I would love to hear from you. And this also spreads the word about our fascinating topic of behavioral finance. As we're moving into, for me, the summer months, it means that the in-person, on-campus classes dies down. We had commencement ceremony on a Saturday, which I believe was the 10th or the 11th of May. And that was really nice. We did our business school commencement ceremony and got to celebrate everyone's graduation. It was a really awesome class of students who I felt really connected to and really celebrating with them and going through that process. But then on the following Monday, literally less than a day after that celebration, or just over a day after that celebration, we're starting a whole new corporate finance online class for the summer. And I got up to, I think, 41. So at Butler University, a small university, that's a pretty big class. And so I quickly went into introduction mode for the whole new group of students. And what's interesting about the corporate finance class, which started last week, Monday, so I'm filming this here in May of 2024. Last week, Monday, we're getting everybody started. And in the class, part of the class is we talk about fundamental stock pricing and the discounted dividend. We'll do dividend growth model. We define the fundamental stock pricing. And so we'll say it's the present value of the future dividends or future flows that you will see in the future. We start with that premise. Well, as we start this class, which this is a part of it later on that we learn, we realize we're seeing on CNBC and on the news that the meme stocks, once again, the two main ones that I always like to look at are the GameStop and the AMC Entertainment. These were the stocks that back in 2020, 2021 shot way up. And I'm talking GameStop. Off the top of my head, was traded at about 3 when Roaring Kitty, Keith Gill on YouTube, started talking about it and started getting people hyped up and got him on a mission and crusade to squeeze the hedge funds that were short the stock, drove it up to about, I want to say, almost $400 at some point. And interestingly enough, the stock you were not able to actually buy the stock. You could only sell the stock on Robinhood. And this was a fascinating story. And you could see that it went back down. And even GameStop, though, was still traded anywhere, I want to say, down to $10. So it's just at $10. And the fundamental value that we have here, it's debatable in what you use and all the assumptions that you use. So we can never say, this is absolutely the fundamental value. But if you want to go, I'm looking at Yahoo Finance, fundamental value, if we're looking at the 1-year target estimate for an aggregate of analysts, they're saying this is a $6 stock. Interestingly enough, AMC Entertainment, the movie theater chain, is also about a $4 stock. Now, we've also talked about the excessive optimism of analysts. So if we're coming up with an estimate, we can safely assume that these are generally optimistic analyst estimates, and yet they're still under what it's currently traded at. So again, it doesn't matter, and that's where we're learning, if people are pushing those prices up. So as I'm doing a good thing, I am riding on my Peloton bike on Monday and Tuesday morning, and it was pre-market trading. I'm watching at CNBC as I'm riding the Peloton because I added like YouTube TV on it, and so I'm just doing my thing, feeling good, and I'm watching the ticker on CNBC, and all the pre-market trading was GameStop, AMC, and I'm going, oh my gosh, are we doing this again? This is part 2, and I'm literally watching this thing tick as I'm on my bike. I was a good boy that day. I did 45 minutes. I think I got about 17 miles in, I think that's about 6 kilometers. And that's my humble brag right there. Did you see how I did that? And anyway, in that 45 minutes time, I'm watching GameStop going from about 29 up into the 40s during those 45 minutes in pre-market trading. And I'm just going, oh my goodness, here we go again. So what we're here to do, though, is we're looking at this, and I just waited. I was like, I want to see how this plays out, because it could have gone a number of different ways. On Tuesday, at the end of the day, on Tuesday, I think that was ended up being the peak. Actually, Monday was the craziness. Monday was where the GameStop peaked around $65. It looks like 69 was the highest trading. That was pre-market. And so, yeah, I guess I was off because when I started that bike ride, it peaked after I got off the bike. I was an early morning rider. Yeah. So it got up to 79 at some point, and then trading, it went down a little bit. But as I'm watching this, I'm thinking about a number of different behavioral factors that come into play here. So first one is going around fundamental stock pricing and then some of the risks involved. So these are the short sellers, some of the risks that they're involved in, even if everyone agrees that this is a $6 stock. So if it's traded at $15, if I'm a hedge fund, I'm going to short that, and eventually it'll come back to what we all agree the fundamental price is, $6. And they'll make money in the process. But the risk involved here, there's a couple of them, but the big one right now for these stocks is called noise trader risk. So noise trader risk has a couple of definitions, but the one here is the possibility that well-disciplined and knowledgeable traders can lose money due to an excess of noise in the market. It is the risk associated with largely uninformed traders who trade on the noise in the market instead of the signal. So this is trading on noise and not market fundamentals. And what we mean by market fundamentals or company fundamentals is that, yes, if GameStop posts their earnings report and their earnings are way above analysts' expectations, by all means, the fundamental stock pricing can be adjusted upwards. If they hit earnings, if they beat earnings estimates, same thing. We can adjust that up, but we should have once we get the numbers crunched, we'll all have a general understanding of what that new fundamental price is. When you have a noise trader, and by the way, when I would teach behavioral finance classes, I would always struggle to find a real good example of noise trading. That was until Roaring Kitty came around, and the noise was essentially, I'm going to post memes and different things, and it's noise. And all he says is, I like the stock. And he started with some compelling, somewhat arguments that GameStop might be a good contender. But when you go back and you listen to it, you're going, wait, GameStop is a brick and mortar company that is selling used games on their console. And so if you put any logic to this, you go, wait a minute, where are we headed in technology? Back to hard copy games? Or are we just going to buy those all online? And also, should we go, are we going to go to brick and mortar to pick this up at our local mall? Or are we going to pick that up on Amazon or anywhere else online? You just go, okay, fundamentally, there's not a compelling argument to make this thing go up. So we just use noise, and it goes beyond fundamentals. So I think I've stated the case here that this is noise trader risk driven by noise. So when you see this, you go, is it fundamental related to the actual company, or is it just noise happening? The fundamentals don't change. And this is the classic case of fundamentals not changing, but the stock price changes based on these rumors. And we call them uninformed traders, and they're doing it for a cause or something else. And that's why we don't see widespread mispricing like we do here when everyone gangs up on a particular stock. So the next thing is, you go, all right, these are uninformed traders. But if I'm here to make money and I'm watching this go up and I'm seeing Roaring Kitty's back 3 years later after his congressional testimony, and he's talking about these stocks again, and he's got some others now in the mix. I know Big Lots was in the mix, and I want to say there's another handful that I'm missing here. But he's getting everybody fired up again, and I'm watching this go up. Now, it stands to reason that I don't have to be uninformed. I'm just trying to make a buck. If I see this at 25, I'm going to buy it at 25, not because I think it's a great value, but I think that I can sell it for a higher price. So the second term I want to introduce you to is called the greater fool theory. The greater fool theory of investing suggests that one can sometimes make money through speculation on overvalued assets. This is it. Items with a purchase price drastically exceeding the intrinsic value, if those assets can later be sold at an even higher price. So if I'm buying it at 25, that's really foolish based off of fundamentals, and it's overvalued already. But if I can sell it to a greater fool, well, I'm going to make a lot of money and I can actually profit from this. So this greater fool theory, we were starting to see, the fools are back. The uninformed traders are back. Let's see how high we can run this, but I'm going to get in early. And so we started seeing this. People started getting in. So even as you're looking at this at 60, you go, well, now this is 10 times its fundamental price based on the analyst recommendations. However, I've seen it go up to $400 before. Maybe it'll go up to $400 again. And I'm going to look pretty good with my position here at $60 per share. And so but you're relying on a greater fool in this circumstance. And so we see that happening. And now, as I'm watching this, and I didn't pay too close of attention to see what Roaring Kitty was continually posting or not. But what I noticed in the upcoming days after that big pop was a sudden drop. And both in all of these meme stocks. So the ones we're talking about, GameStop, and the other one is AMC. And so now I'm sitting here on Monday, the following Monday. I wanted it all to play out. This is back down to GME. GameStop is down to $19.52, so below $20, and that is down from 80 So now we're going to be down 75% from its high. And so instead of going to 400, it quickly bounced back. It lost all momentum. Anybody who participated in the greater fool theory lost a lot of money. And it's still elevated from where it was before, but it has gone down considerably. And same thing with AMC. AMC is trying to get another rally going, and it did top off at, where were we? I'm just looking at daily charts, 12, and then now it's back down to 445 or 444, which coincidentally is their target estimate. So that also popped back. So the third point that I want to make, though, is traders, even uninformed, unsophisticated traders, are learning their lesson in some of these mispricings. Those who were dabbling in GameStop at 200, 300, 400 saw and experienced how that works for them when the bubble comes out, when the bubble bursts essentially and goes back gravitating towards its fundamental price. And so you have almost this experiential learning for people going, all right, it's on its way back up, but man, I next time am going to lock in my profits. I don't care about the hedge funds anymore because I lost my shirt last time. So I'm going to ride this. And as soon as there's a whiff of a pullback, I'm out. And if most investors are doing that, well, now all of a sudden, as soon as that downshift happens, it is a mad dash for the exit. So you see the air come out of the bubble very, very quickly. And this is what typically happens. We've seen this with some of the other market anomalies. Momentum trading was a big one for a while. And I did some research in that. And my first paper that I ever wrote was showing that retail investors could actually benefit if we looked back historically from momentum investing. So buying the previous winners and I guess it was a long only portfolio and holding them for 6 to 12 months. So when I came back and I did another project along the same lines, and I was trying to look at something else, I found that after the financial crisis, momentum investing returns were non-existent. It was dead flat after that. And what I concluded is people get smarter, and when everyone's getting smarter, the mispricing goes away. And so I see this in these meme stocks as it's played out. I think that maybe some of these investors are becoming more sophisticated, and that's why we did not see the run up that we did. And I don't know what Roaring Kitty did. Maybe there was something else. If there was, shoot me a note in the comments. I would love to get more insight into this. If you're looking for more information on the first ride up and getting some more color behind that, there's a great documentary called Dumb Money, and I believe that's on Netflix. So you can check that out as well. And otherwise, I just wanted to share that with you. I can go back now and have more credence as I'm talking about fundamental stock pricing here in my online class, hopefully, and continue on that. But then also show you that investors can be crazy at times and very irrational. And it's my plug to come into my behavioral finance class for the finance majors, take that as an elective. And then also, speaking of, I will be recording my behavioral finance course and we'll be packaging that. I've been talking about this for a long time, I know, and I am my own case study in procrastination in this case. But I've got all of the pieces together, all of the audio visual together to actually make it look hopefully decent. And we'll be rolling that out here in the next couple of weeks. So please stay tuned. And thanks again for listening today. If you want to contact me, I would love to hear from you. And you can find me on YouTube you can find me on brtanfoltice.com. Instagram, you'll see me. Before this summer is over, you're going to be seeing me on more on LinkedIn. We're even going to do some TikToks. I'm not going to do any dancing though, just for information purposes. And then also on Facebook, we're going to get that. It's up, but now we're going to get some meat behind that. So all of these different places, you can find me. You can contact me. I would love to hear from you. If you need me to speak at your seminar or your class, your congregation, I'm fired up and recharged and ready to do that. So let me know how I can serve you. Otherwise, have a wonderful day. Have a great week, and we'll talk to you later.
Thank you for tuning in to another episode of the Brtan Foltice Behavioral Finance Podcast. We hope you found our exploration into the fascinating world of human behavior and finance both enlightening and thought-provoking. Be sure to subscribe for future episodes. And until next time, stay curious and financially savvy.